Okay, it looks like the record is going. So, welcome everybody. I'm really glad everyone's here because this is a subject that interests me. As a former floor trader on the options floor, trading options on wheat, trading options on S&P futures, and building a trading floor on the options floor of the Pacific Exchange, I really understand that option activity can have a significant impact, or as in poker, they say a tell on the behavior of the underlying asset class. And so I'm very happy to introduce James Ramelli. He's a trader and options educator at Alpha Shark Trading, and where he actively trades futures, equity options, currency pairs, and commodities. As one of the moderators of the live trading room, Ramelli educates members on strategies, trade setups, risk management, while trading his own capital. So there he is, all exposed. Ramelli regularly appears on Bloomberg TV, BNN, CBOE TV, in addition to writing a weekly column for Futures Magazine, and is featured in the CME Group's Open Markets as a guest contributor. Mr. Ramelli holds a BS in finance with concentration in derivatives and financial engineering from the University of Illinois at Urbana-Champaign, and he can be contacted. In fact, we'll have his email, james@alphashark.com. And so welcome. And I'm looking forward to the presentation. This is going to be probably as much of interest to me as everybody else out there. And so I'll take it away. Oh, one thing that James did say is that he welcomes questions during the presentation. He would prefer to handle those while we're talking about the issue he's discussing. So feel free to enter any questions into the Q&A box. And if you have something that's more complicated or a question you would ask verbally, and you have a microphone specifically, it'd be nice, a headset, so we don't get feedback. I'll just type it in, say voice question or something like that, and I will see if I can promote you to a panelist so that we can actually hear what you have to say. So welcome, James. I'm eager to hear what you have to say.
All right, thank you very much for that fantastic introduction. So one thing that I want to do before I touch on anything else that I'm going to talk about here is I want to get a sense of what you guys think unusual options activity is, and more so, have any of you in here never once heard that term used before, either on CNBC or Bloomberg TV in an article you've read? Has anyone never heard of unusual options activity? Has anyone never considered looking for unusual options activity as a way to look for a particular trade setup? And good, so there's several people that are, and just type into the question box here, several people are saying that yes, they've never heard of this topic before, and that's fantastic. So with that, let's jump right in here. Before we do, I am going to read our standard boilerplate risk disclaimer. Day trading, short-term trading, options trading, and futures trading are extremely risky undertakings. They generally are not appropriate for someone with limited capital, little or no trading experience, and or a low tolerance for risk. Never execute a trade unless you can afford to and are prepared to lose your entire investment. All trading operations involve serious risks, and you can lose your entire investment. No trades are recommendations or advice, and we cannot be sued for losses of capital. All trades are for educational purposes only. Please contact your broker or registered investment advisor for execution, margin, and capital requirement questions. Everyone watching this presentation here's all disclaimers on optionhacker.com, keenonthemarket.com, and alphashark.com. So I'm not going to talk about myself too much because Richard did a fantastic job of introducing me. But my name is James Ramelli. I actively trade equities and equity options. Now I say that I am an equities and equity options trader. I used to trade all of those other products as well, futures, options on futures, currency pairs, but I've shifted what is probably now 98% of all of my trading into equities and equity options. And the reason that I have done that is because I have not been able to find Edge anywhere like I can in the equity options market. Ooh. Oh, can you guys still hear me?
I can.
It seemed like can you guys still see the screen too? It seemed like I just got an error message there.
I turned off my video so it wouldn't be a distraction, but I can see the screen on my laptop. So
okay, great, fantastic. I just wanted to make sure that that wasn't something on my end. Alrighty, so I trade equity options and equities now because I think that unusual options activity gives me more edge in those markets than I can find pretty much anywhere else, right? And we're going to talk a lot more about why I think that's the case, and we're going to have some examples here as to why I think this concept doesn't necessarily apply itself all that well to indices or commodities or futures, but as was said, I'm regularly on CNBC, Bloomberg, Fox Business, BNN. So maybe you've seen me on TV, maybe you haven't. If not, maybe you've read something I've written. But let's jump right into the topic here and talk about unusual options activity. Unusual options activity is fairly simple to define, but when we're trying to find actionable trading ideas in practice, it gets much more complicated. So simply defined, unusual options activity is any options order that is taking place above the average daily options volume in a given stock. Okay, so that's what's really important to understand here. It's about the average daily options volume in a given stock. People ask me all the time, am I looking for orders that are 10,000 contracts or more? Am I looking for orders that are 20,000 contracts or more? What actually is going to signify unusual options activity to me? And my answer always is, listen, a 1,000 lot order might be just as unusual as a 20,000 lot order, depending on the stock that you see it coming across in. Right? And that just makes sense. Apple trades a lot more options in a day than a stock like XLNX, right? SPY trades a ton of options in a day. There really isn't such a thing as unusual options activity in names like that because their average daily volume is so high. But what these orders let me do is they let me look into institutional order flow and see where big money and smart money are pressing their bets. Before everyone was getting into the room here this morning or this afternoon, me and Richard were talking about how the trading day went. And I say all the time, what I use unusual options activity for is to look where big money is pressing their longs, pressing their shorts when we see the market moving a lot like we did today. And it lets me as a retail trader, because just like all of you guys, I am now a retail trader. I trade upstairs behind the screen using retail trading platforms. My main platform that I use is thinkorswim, which I'm sure that most of you in here probably use that because statistically most of you use thinkorswim. But the reason that I care so much about the options order flow is because of the way the equity options market is structured. And one thing that people ask me all the time is, well, if this is such a good concept, then how come I can't look for unusual order flow in the options markets in crude oil or nat gas or something like the SPX or the OEX or an index? And the reason for that is because there isn't going to be the upside of insider information. And we're going to talk a little bit about that on the next slide here. But one of the main reasons why this concept doesn't work in something like futures or stock, particularly stock, is because a lot of the order flow in the stock market is no longer visible for retail traders. Okay, so let's talk a little bit about how the order process works in the equity options market. An institutional trader is going to come up with a trade. They're going to do this after they've done a ton of research with all the information they have, a lot of analysis, and we're going to talk about why that analysis is a little bit more intensive on the next slide here. But after they have their trading idea, buying 10,000 out of the money calls in stock XYZ for this price, they're going to call their broker to get the trade executed. The broker, if the order is of size, will shop that order around all over the place. Citadel, Goldman Sachs, Barclays, any big options market making desk that they think they can get their client's order filled at. If none of those guys want it, they'll send the order to the floor. And if it doesn't get filled there, the broker has a choice. They can either fill the order for their customer and hedge out the risk themselves, or tell their customer, hey, no fill. But what's really important to understand is that at no point throughout this process do they have the option of sending the order to a dark pool. And if anyone doesn't know what a dark pool is, and I'm sure many of you don't, it's a center of liquidity that is off of the exchange where big institutional equities traders can transact with each other. Okay, they can come in and buy and sell stock with each other, and all of that volume doesn't show up on the chart that I look at in thinkorswim. All of that volume is not represented in the total number of shares traded listed on the NYSE or the NASDAQ at the end of the day. Someone says, hope you will cover how to identify which direction the institution has taken, buy or sell. Yes, absolutely, of course. Yeah, we're going to talk about that, and we're going to talk about why I'm able to do this in the options market and what it is I look for to determine what the institutional trader is actually positioning themselves for in the options market. But if I was to try and track big order flow in the stock market, I know that most of that order flow is lost in a dark pool, and lost in dark pools. Citadel, which is down the street here in Chicago, operates a massive dark pool that hedge funds trade in all the time. And after the first hour of trading rolls by in the morning, they've already traded more stock than the New York Stock Exchange will trade all day. So I have to understand that for equities, that order flow is all hidden. But for options, they don't have that ability. All of the equity options order flow must go through a public exchange at some point, whether it's the SIBO, the PHLX, ARCA, BATS, the BSX, the Miami Options Exchange. No matter what they do, it has to go through one of these public exchanges. So all of the pertinent information surrounding that trade must be made public and must be made available for market participants. Okay, so they're able to hide their stock volume and their stock orders, but they can't do it in options. Anytime an options order is taking place, I am able to find that order. Whether it's a 1 lot or a 100,000 lot, I'm able to find it. I just have to know how to look for it. Okay? So let's talk a little bit about, before we jump into what the order flow actually looks like, let's talk a little bit about why I care about the order flow, right? Because a lot of people say to me all of the time, how do I know which funds I want to follow? How do I know that the hedge fund or mutual fund or big trader that's on the other side of this order flow actually knows what they're doing, right? And, I don't ever claim that they know 100% of the time the direction that a stock is going to move in. But one thing that I do truly believe is that they have advantages that I can never get myself, or they're on a playing field that is very difficult for me as a retail trader to get to. And the main reason for that is they have more capital. Their capital gives them access to more capital at a cheaper price. It allows them to take more risk. But main thing that it gives them access to are these three things: manpower, technology, and information. And let's start with information. One more question that I have for you guys, and I shouldn't say one more question, I have many more questions for you, but one more question that I have for you guys is, does anybody in here think that insider trading doesn't really happen that often on the institutional level? Does anybody think that? This is one I'd really be surprised if anyone answered yes. I think that institutional traders never commit insider trading, right? We know that it happens fairly often, right? Because we read about it in the news, we see it on TV, we read about it online. These guys get caught trading options using information that they're not supposed to have, or at the very least information that they're not supposed to be trading off of. So institutional traders do this, and they do it in size that you would be surprised, because logically one would think if an institutional trader has a piece of insider information, they would want to be as subtle as they possibly could about putting on their trade that gives them that upside exposure. But we're going to go through some examples here where you're going to see that that isn't really the case. It's not really how they do it. And we're going to talk a little bit about why that is. Mostly it's because these guys rarely get caught. But a study was published about 2 years ago that said of every M&A deal that happens in a year, 25 to 30% of them will have some type of unusual options activity ahead of the deal that telegraphs the move higher, right? And why does this happen? Because there's leaks. It takes a lot of people to close a massive merger and acquisition deal. It takes a lot of people to close big deals that have material price effects on the price of the stock. But let's for one moment assume that no one is using insider information, and that they're using only information that everyone has access to, that if we had the time, me and you could find either in financial statements, online, anywhere that it would be available. And let's say that that's the only information that they're using. Well, the technology and the manpower that they use to process that information is going to be something that is far greater and far more advanced than I'm ever going to have access to. I'm always going to be limited by the fact that I am one person. I am one man, and I cannot do more than 24 hours worth of work in a day, right? I don't know how much time you guys spend outside of market hours on a regular week going over financial statements, looking at charts, reading articles online relevant to the companies that you hold in your portfolio, coming to webinars like this to see presentations so you can learn more about trading. It's probably a fair amount of time, because if it's anything close to what I do, it's almost like another full-time job. But no matter what I do, it's never going to be enough to compare with a team of 6 PhDs sitting at an options desk at a quant fund, right? I can never compete with them. But what's really great is that everything that they do has one end goal in mind, and that is a trade, right? Everything they do is to get to this end goal of a trading idea or strategy that they're going to execute in the market. So even though I can never play this game as well as they can, I can find the end result of that. And so our entire trading plan is about finding the order flow that is the result of their higher level analysis, the more information that they have, and in many cases, the insider information that they're not supposed to be trading on. So let's take a look at an example of what this actually looks like when we see it taking place in real time. So this is a little snippet of information that came across a scanner called Trade Alert. You don't necessarily need to have Trade Alert as a scanner to find this order flow. Many retail platforms like thinkorswim, like TradeStation, have unusual options activity scanners. We offer a scanner as well that's much cheaper than the ones that some of the institutional desks use. But even the most expensive one out there that you can find is only going to be something like $300 to $500 a month. But you can get this information in a lot of places, and I'm going to tell you guys all the different places you can get it towards the end of the presentation here. But no matter where you get it from, and you can even find it on the time and sales window in your trading platform, this is all the information that you're going to be able to get, because all this information must be made public by exchanges when orders take place. So this was an order that hit the tape sometime in late June in ConAgra, and you can see there's a lot of information for me to digest here right away. I can see the time this order took place, I can see whether it was bought or sold, and I'll talk about how we know that in a second, the size of the trade, the stock, whether it was a call or put, the expiration, the price it traded at, and the exchange bid and offer at the time of the trade, whether it was an opening or closing position, and the price of the stock. So what is the first thing that I notice right away here? The first thing that I see is that this is a big trade. A 5,000 lot at $1.08 is a $540,000 bet. Okay, now in some stocks that wouldn't even draw my attention for a second look. But in a stock like ConAgra, that is a big bet. How often do you guys think institutional traders and hedge funds come in and put on huge, over $500,000 bets on derivatives in ConAgra? Does ConAgra strike you as a stock that has a bunch of wild swings that momentum funds love to trade? No, it definitely doesn't, right? And at the time that this order took place, these were front month options. So someone was coming in and putting on a very aggressive bet using out of the money calls that ConAgra was going to be significantly higher by the expiration of these options. Because remember, with the 39 strike calls being bought for $1.08, their break even is above $40. So they need a pretty decent sized move in this to hope to make any money here. And the stock was trading at 38.29 at the time of the trade. I can tell you the exact date that this trade took place. It was June 16th of this year. Okay. One other thing that I noticed right away as well is that the market was 90 cents at $1.05 when this trade took place, and that the trader paid through the market maker's offer. Why did they do that? Because they wanted to get filled on this trade. They wanted to get filled as quickly as they could in the size that they wanted. So they paid more than the best offer in the world. Aggressive. This shows me just how aggressive this trade was. Now let's take a look at what happened to ConAgra after this order took place. Like I said, it took place on the 16th of June, and don't mind the other indicators I have in my chart here. These are all other things that we use that aren't necessary for trading unusual options activity. So this took place on the 16th. So where is the 16th? The 16th is right here. So this is the day that the order took place. 3 days later, on the 19th, an announcement was made by Jana Capital that they're going to be taking a 7% stake in ConAgra, and the stock explodes to the upside ahead of expiration. These options traded as high as $6 after this order hit the tape. So looking at that type of price action and seeing that the stock ripped higher on news, what do you think is the most likely scenario here? Did this trader get lucky in his entry and just so happened to buy a massive position in these options days before an announcement was made that set the stock 10% higher on the opening print? Or did he know that that announcement was going to be made? Did he know for a fact that JANA was going to make an announcement that they were taking a large stake in ConAgra, right? Inside info, and everyone is going to answer. Everyone is going to say that it's fairly obvious that he knew what was going on here. Okay, so not every single trade is going to be like that, right? I would hope that in a year I catch maybe 5 or 6 positions like this where I see a massive move higher on news, and I can give you guys a huge list of a bunch of ones that we've seen this year, and we're actually going to go over an example of the best one I've seen all year in the next couple of slides here. But what's more typical is order flow that we see like this, okay? And for those of you that were here a little bit early and you heard me and Richard speaking, he was talking about when on the trading floor, they would see brokers that they knew represented big clients coming around the corner. They would come in and start to pre-hedge themselves and put on positions knowing that something was about to happen, right? Knowing that they just got this feeling when they saw these types of things developing that something was about to happen. That's exactly how I felt when I saw this Dean Foods order hitting the tape the other day. So this was from an order that hit the tape last week, and it was the morning after Dean Foods reported earnings. Okay, they reported earnings on the 10th, the morning of the 10th, and this order took place that day. Okay, this is a big order for front month options in Dean Foods, but what was really interesting is that the stock was getting crushed when this order came across the tape. The stock was getting crushed, and at the same time had been listed as short stock restricted. And what do we see? We see 1,000 lot of Dean Foods 16 strike calls being bought for 35 cents. Now, notationally, this isn't a massive bet. It's $35,000 worth of premium. If this trade were to go to zero, that's all that this trader would lose in this situation. But what's interesting is that Dean Foods doesn't catch that much equity options order flow. And for the timing of this to be taking place exactly when it did, it was incredibly suspicious looking. One of the things that I'm looking for as well, and not every trade, like I said, is going to be driven by insider information. I'm looking for where institutional money is pressing their bets, right? Where they're looking to play with momentum that I'm seeing develop, because I think that's going to be the strongest type of order flow that I see. When the momentum is agreeing with the order flow that comes across, and someone out there at a hedge fund, at a mutual fund is coming in to bet a lot of money that the momentum is going to continue, it's like jumping onto a wave, right? I can see them pressing their bets. The equity options market tends to lead the stock market a little bit. And look at what happened after this order hit the tape. So this order hit the tape early in the morning, and it hit the tape after, and this arrow is actually in the wrong spot. This hit the tape shortly after the open, and it started to hit the tape right when the stock started to bottom out in this area here. And what happened? I can see that there's a couple of very bullish bars being put together here in Dean Foods. So when a stock starts to rally hard off of lows and it's short stock restricted, what does that spell? What is the potential after we see something like that happen? Well, the potential is a short squeeze, right? We know that the momentum can continue higher, squeeze out these shorts, and that we can see a pretty decent size move in the stock. And you can see this is actually where the session broke that day. It continued higher through the next day, right? And if you take a look at the daily chart in Dean Foods, you see the same thing. So once I see that dynamic developing, I know that it's something that I want to pay attention to, right? As of the next morning, those calls were $2 at $2.15, right? So if I would have bought a 20 lot of those calls and held them overnight, I would have profited $3,300 at the highs and only $700 worth of risk, right? This is how much money options traders can make. We have a leveraged product. Options have inherent leverage that I can use to my advantage. So this is an example of something that is a little bit more typical of what I'm looking for on a daily basis. And we can look at an example in XLNX after we go over this next one as well. And that's one from today that I traded and was able to net some nice profits in.
Great, and I'll stop you for a second. Say, if you have any questions up to the state, please type them into the Q&A box so that we can deal with them while he is on the topic that he's working on. So please feel free to ask any questions you have. And this is really fascinating. Thanks, James. You've got me glued to the screen here.
Thank you very much, Richard. Yeah, and like Richard said, please, 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 if you have any questions, even if you think that it's a question that is too simple or something I've already covered or something I may have kind of glossed over here, please ask, because I understand that this is a topic that a lot of people aren't that familiar with. And trust me, I've heard every single question you could possibly ask, and I've never thought that anyone has ever asked me a dumb question. There's no such thing, right? Especially when we're talking about something as novel as trading unusual options activity that isn't really, out there and published about extensively. I know you guys are going to have questions, so please, please interrupt me if you want to ask me something. I would be more than happy to go back or expand more. All right, maybe once we get into the actual trading plan, you guys will have some more questions here. So let's take a look at another example here. And this next example is going to be more so on the side of the insider trading type of example that we see in equity options. So this is only one order of several large orders in craft that we saw this day, March 10th. Okay. Someone says, I presume you are not always looking at the front month. No, I am not always looking at front month options. Not always looking at. So in this example in craft, these options were not front month, as you can see. This trade hit the tape on March 10th, and they were June options. And what's really great about unusual, and that's a fantastic question, Norman, thank you. What's really great about unusual options activity and following order flow like this is if you're someone who doesn't want to be in short dated options or someone who likes to take more longer term swing trades, all you have to do is look for that order flow that it's dated further on, because hedge funds do it all, right? They bet on the price, on where the price of craft is going to be at the end of the week. They bet on where the price of craft is going to be at the end of the year and out. They do this for all stocks, right? So all I need to do is focus on order flow that's most relevant to me. If I'm a day trader, I might look at something that is focused on mostly weekly options and front month options, because I know I want moves to happen quickly. I know I don't want to hold anything overnight. And if someone's coming in and putting on a big bet in weekly options, are they expecting the move to happen sooner or later? They're expecting it to happen sooner. So that's the type of order flow that I want to pay attention to. Okay, so someone says, how much time do you spend digesting an alert? Many times there are probably several legs on these trades which may or may not shape up, perhaps skewing the expected movement. Right, and that's a great question. And what we typically look for, because hedge funds are going to trade all sorts of strategies, whether they're more complex, three-legged spreads, risk reversals, collars, reversal conversions, butterflies, iron condors. They do all of that. So when I'm looking for order flow that I want to, use as actionable equity options, unusual options activity, I'm typically looking for outright calls and puts. And the main reason for that is it's the easiest thing to digest and dissect in terms of order flow. And what's great about equity options is that if someone is coming in and putting on, say, a calendar spread, an institution, I'm going to be able to see that, right? If I see 5,000 calls, front month calls being sold right next to 5,000 of next month's calls being bought, I'm going to know that that's a calendar spread, right? And more often than not, when an institution trades a spread, it comes across labeled as a spread. The brokers are supposed to do that, right? So someone says, at the intro you mentioned that this strategy works best for options, but not so good for yeah. Okay. So John, just bear with me for 1 second here. I'll get to that question on the next slide, on the next 2 slides here. But take a look here at what happened in craft. This was a massive bet, and it kind of has the same logic as that ConAgra trade behind it. This was something that we saw coming across the tape with other blocks of out-of-the-money calls in equal size. And again, is craft a name that's a big momentum name that hedge funds want to be involved with, using derivatives all the time, where they're coming in and putting on big bets using equity options? No, it's not. It's a relatively boring stock, right? And I love to see enormous equity options order flow in boring stocks, because that signals to me right away that something might be up, that something might be fishy. I automatically get that feeling that something is about to happen. And look what happened to craft. And most of you know what happened to craft, right? Craft announced about 2 weeks later, that they were going to merge with Heinz, that Kraft shareholders were going to see a enormous special dividend. The company now trades under KHC, so if you're wondering why I have this old chart, it's because you can't get a real-time chart of KRFT anymore because it doesn't trade, doesn't exist. But these options traded as high as $22.40 after these calls, or after the announcement was made. So a trader who would have had 5,000 of them made over $11 million in just 2 weeks on the announcement of this Kraft deal. And if I was someone who followed that incredibly suspicious order flow in Kraft, I would have seen profits of over $2,200 per one lot, right? So if I would have bought 10 of them, that's a $22,000 profit on a very small amount of risk. Now, like I said, this isn't the typical type of return that you see. This is the best one that I've seen in like 2 years, right? Massive, massive, massive returns on this. And again, with a deal of this size, you have to ask yourself, did this trader know that this was going to happen, or did they just get lucky? And it seems fairly clear again that this trader just got lucky.
You are so cynical, James. These innocent traders out there that are just putting on these big, huge trades in very quiet stocks, and they just happen to explode. It's just luck. Come on.
Right, absolutely, absolutely. And the more that you watch this happen, and you look at two examples here that are, only a couple of months apart from each other, and you ask yourself, how is it that they can bring themselves to continue to do this all of the time? If guys like me are noticing this, isn't the SEC, aren't the regulators whose jobs it is to find people doing these things noticing? And the answer to that question is complicated, right? We know that the regulatory environment is relatively complicated, but what is, I think, the main reason that they continue to do this is that they know even if they do get caught, nobody's going to jail, right? They're most likely going to have to pay a fine. They're going to have to pay a fine, and that's if they get caught. The SEC has a massive, massive backlog of cases that they have to get through. They're still working on stuff from 2008. By the time they get around to finding this trader or investigating this type of trading, years may have passed, and trying to figure out who knew what when the trade was executed, what information was in what people's hands, it can be pretty murky. So most people are convinced that do this, they're never going to get caught. And that's pretty much what we believe too. Hedge funds and big traders have more information than us. Whether or not that information is, I believe it's higher quality. Whether or not the quality of that information is better because they had a team of people going through it and doing analysis, or the information is better because a VP of Kraft or Heinz just so happens to be in there, forced them at the country club and gave them a little bit of a tip, it doesn't really matter to me, right? Because I still care about the order flow. Activist investors, big hedge fund guys, they use the equity options market to wedge themselves into stock positions before they disclose that they're taking a stake. Maybe that's what we saw in ConAgra. Maybe ConAgra wasn't necessarily someone who knew that JANA was going to be making that announcement. Maybe it was someone at JANA who was using those options to wedge themselves in there when the announcement was made so they could get more stock, right? But what's important to understand, and people ask me this all the time, is if I follow an insider trader's order flow, have I done anything wrong? Am I culpable for anything? And the answer is absolutely not, right? As soon as that order hits the tape, it becomes public information. As an institutional trader, if I have information that no one else has that is material to the price of the stock, and I click the mouse and make a trade, or I call up my broker and make a trade, I've broken the law. Right away, I've done something wrong, and if I get caught, I'm in trouble. But as soon as my trade is executed and that order comes across the tape and it hits the time and sales window, it becomes public information, and anyone watching can do whatever they want with it. They can use that to set up a trading strategy of their own, right? And they've done nothing wrong. So someone asked, and I want to get to some questions here because this ties into exactly what I was just saying. Someone asked, why is it that you don't like this for other things, right? Specifically, options on commodities, indices, things like that. One of the big upsides of watching this order flow is the potential for it to be order flow that's taking place on insider information, right? That's one of the big upsides. When I take that Kraft trade and I watch that thing trade afterwards, I know that it's not super likely that Kraft is going to have some big kind of merger coming out, but I know that there's always a possibility. There's no possibility of, crude oil coming in and making a hostile takeover bid for natural gas, right? The S&P isn't going to come in and make a bid for the Dow, right? So that whole idea of, that extra piece of upside from insider information, that goes away when we look at indices, when we look at commodities, right? And one of the things that also kind of drives that way of thinking as well is that, indices and ETFs that track specific sectors, most of the order flow that comes into those has a higher chance of being a hedge. I might see, and we see this on a regular basis, I might see someone come in and buy $15 million worth of upside calls in the VIX, right? And that's a big bet, right? That's a big bet. It's going to be a notationally large and significant number of contracts. But every single month, I see those go to zero. And why is that? Then why do they keep doing it, right? Why do they keep doing it? Because that $15 million bet that they're putting on in the VIX is a hedge against their $15 billion long equity book or something. I can never know for sure what they're doing. So one of the things that I have to do when I'm looking for order flow is make a determination as to whether or not the order is more likely to be a speculative bet or a hedge. I don't want to be buying institutional traders' hedges, because they're hoping that those go to zero. If their hedge goes to zero, that's great, because it means they didn't get killed in their underlying position. Okay? Someone says, where can I find an options scanner? So yeah, one of the scanners that we offer, Option Hacker. I saw someone mention that. Trade Alert is a scanner that is fantastic. Options Flux is a scanner that I've used in the past. Thinkorswim has one built into its platform, as does TradeStation. So popular retail platforms that have it built in as part of their platform at no additional charge. Okay, so any questions so far? We're about to jump into now, once I see this order flow, how do I know that it's actionable order flow? How do I know that I can use it to make a trade?
Great. There's one question, I don't know if you saw it, about FCX and puts. Are puts harder to interpret than calls due to hedging by big firms?
Yeah, so that's a great question, and I actually had my finger on the trigger to buy those same FCX puts, and I didn't do it because I thought it looked a little extended that day. But puts are used by big firms to hedge long stock positions. So when I look at a big block of puts being bought, I have to ask myself, is it more likely that these puts are being bought as a hedge, or is it more likely that these puts are being bought as further downside speculation? And the chart of a stock helps me do that, and we're going to get into that in the next couple of slides here once we get into the trading plan. But there's little things that you can look at that can make that a lot easier. And what's really great is that even though that FCX order is huge, if I want to be very selective and I want to say I only want to take trades that look perfect, well, I can do that. Hedge funds aren't going to stop trading, right? They're going to continue to trade, and they're going to create order flow. They're always going to. That's their whole business. It's not like if I pass on one setup that turns out to be profitable, there isn't going to be another one that comes across the next day. So one thing that I can do is look at charts, and we're going to talk about that in a little bit, but an easy way to think about this is if I'm looking at a stock that just made new 52-week highs or is trading just off of its 52-week highs, and I see 23,000 puts bought, is it more likely in that case that the order is a speculative bet or a hedge? Well, in that case, it's more likely that the order is a speculative bet, or a hedge. Institutions, do you guys think that they tend to trade with momentum or against it? They tend to trade with momentum. They're the ones creating the momentum. They don't want to be fighting momentum in markets. Hedge funds love to trade with momentum. So if I can establish where the general momentum is, I can determine whether or not an order is more likely to be a hedge or a speculative bet. And I have some technical indicators that I use. I'm going to show you guys in the next couple of slides here. Well, let's take a look here at an example that happened 2 weeks ago today. And then we're going to look at another example that happened today. I just didn't have time to make nice, pretty-looking slides for it because it happened a couple hours ago. But we have a trading plan that we call the Ribbit trading plan. And it's an acronym. It's not something that is super eloquent sounding. If you have some suggestions, we're more than happy to hear them. But it's a 7-step trading plan. And what it has me do is analyze this order flow the same way every single time. And it helps me go through this in steps. And at any point throughout the trading plan, if one of the steps tells me, hey, this might be something you don't want to trade or something you might want to avoid, I can easily move on to the next thing. Okay, so this is an example of more of a day trade setup, right? So this happened 2 weeks ago, and we see 3,000 of the EPD AUG 25 puts bought for 40 cents, right? This is a relatively large bet. Okay, this trader came in, bought these midday, and midday is kind of a weird time for a big options bet to hit the tape. We typically tend to see things slow down during that time, right? But one thing that I noticed right away is that they're coming in and buying puts that are over $1 out of the money. They're $1.34 out of the money as the stock was making new 52-week lows, right? So one thing that I see and think about right away is, hey, this kind of looks like a trader out there is pressing a lot of capital into this short position as the stock makes 52-week lows. So I know that the momentum is already going to be interesting for me. I already know that it's probably going to be on the side of a bearish bet. But the first thing I need to do is determine whether or not the trade is opening or closing. Now, what's great about this signal is that it's labeled opening. So I know that it's opening, but not every position that is opening will be labeled as such. Brokers are supposed to label it. The exchange is supposed to tag it. It doesn't always happen. But one thing that I can do to make sure every time with beyond the shadow of a doubt that it is opening is look at the volume and open interest. So let's assume for a moment that this wasn't here, that this wasn't labeled opening. Okay, how would I know that this is an opening position? Because I don't want to trade, oh geez, I thought that was going to be a little bit darker. I don't want to trade positions that are closing, right? I want to get in when the hedge fund gets in. I want to get out when they get out. I don't want to get into a trade as they're getting out of it. And when you see options bought, it doesn't necessarily mean that it's an opening position. If a trader short 10,000 calls and buys 10,000 calls, I might see that 10,000 lot hitting the tape as a buy order and say, whoa, what a big bet. But really all they're doing is getting out of their position.
In fact, one time on the floor, an order was misrepresented as closing when it was opening. And so it was Microsoft, I believe. And so we as option traders just really piled onto it. And it was an opening position, taking the bet just like you're describing here. And we all got killed. And it ended up, there was a lawsuit over it.
Right, absolutely. And, I really, really need to make sure without a single shred of a doubt that a position is opening before I even go to the second step of the trading plan. And this is what the O in the Ribbit trading plan stands for, open interest. So if volume is greater than open interest, the trade has to be an opening position. Think about that logically. If I see 10,000 calls being bought against open interest of 5,000, or even if I see 10,000 calls being bought against open interest of 9,900, I know that it's an opening position, right? Because it's one block trade and there isn't 10,000 contracts there for them to close. There's no way they could have been short 10,000 to buy one block as a sweep of a 10,000 lot. So in this position here, I see 3,000 being bought against 484 in open interest. It's labeled opening, so I didn't need to do that check. But if it wasn't, I could, and I can say with beyond the shadow of a doubt that this is an opening position. If volume is less than open interest and the order is not labeled opening, the trade could be closing. Just because volume is less than open interest doesn't mean that it's closing either. If it's labeled opening, it's opening. But what I want to focus on are opening orders that have big volume over open interest. What do you guys think is more significant? An order that comes in for a buy of 5,000 calls against open interest of 0, or a buy of 15,000 calls against open interest of 10,000? Right? One of them is bigger. One of them has more notational risk in it, but the order of 5,000 against no open interest is much more significant, right? Because it shows initiating buyers. No one else is involved in this right now. It's much more unusual. It sticks out more. Sticks out like a sore thumb, right? So once I determine that a position is opening for sure, without a shadow of a doubt, I can then determine whether or not the order is a hedge or a speculative bet. And this is where a lot of people get confused in the trading plan because this is the most subjective part of it. I can't ever say for sure. I'm never going to be able to say with 100% certainty that an order is a speculative bet or a hedge, right? So what I need to do is have a best guess or a best determination. And what I use to do that is the chart. Because I truly believe that the majority of institutions out there, especially hedge funds, are trading with momentum. So I need to determine what the trend is telling me and what price action indicates is the most likely case. So what I want to look at is an indicator called the Ichimoku cloud. And for those of you that have never used the Ichimoku cloud before, it's probably going to look pretty intimidating when I show it to you, but you have to understand that it's actually super simple to read. All right, so I believe that this is the best indicator in terms of finding trend and determining where the trend is going in a stock. So what we see here is a bunch of lines, and what we're looking at is a set of moving averages. But the simplest explanation that I can give you guys for this, and really the only one that you need to know for this trading plan, is that this shaded area that you see here, this shaded area kind of draws the line in the sand between bullish and bearish territory in this stock. So anything trading above it is in bullish territory or potentially bullish territory, and anything trading below it, which is this huge chunk of price action here, is in bearish territory. What I want to look for is where it broke these levels to the upside or downside and how the trend is playing after that happened. So what do we see here? I can see that every single time we've tried to rally above the cloud here in EPD, it's sold off, but until it broke the cloud at this point and really started to sell off. So I can say to myself, I know that this trend is very bearish. I can also look at this and see that they just recently reported earnings and the stock had gapped lower on earnings. So once they have had bad earnings in bearish territory and the stock continued to sell off, would I be more likely to think that a trader coming in and buying front month puts is speculating on further downside, or are they looking to put on protection or a hedge, right? Odds are this is speculation to the downside. They're not coming in to look to buy protection over the next couple of weeks in EPD after they've just had a awful quarter earnings-wise, right? It doesn't work that way. It's typically not the type of order flow that they tend to do. So once I know that I probably want to be on the side of this trader and follow this momentum in this kind of short-term bearish bet that he's putting on, what do I want to do? I need to make sure that the risk and reward lines up with my general risk tolerances and overall position sizing rules that I might have. I, for one, will never put more than 5% of my book in any one position. And there's a reason that I do that, right? I never want to have a black swan or catalyst event take out a huge chunk of my book unexpectedly. And in individual equities, this can happen far more often than it could in commodities or indices. I'm sure Richard could tell you that as an equity options trader, it probably happened to him more than a few times, probably several more times than it did when he was trading wheat or indices, right?
Well, that's absolutely right. And again, every morning as the risk manager, I would come in and say, okay, if there is a black swan event, if there is a huge move, if it's systemic in the entire market or if it's in one, we would analyze and say, is this going to take out more than 10%? And you know, in the crash of '87 and the further big moves and all the earnings disappointments and the accounting frauds, I'm thinking of Comdisco and, you know, all that stuff, we always looked and said, my goodness, is this going to take us out? And the worst thing that ever happened was a 15% drawdown, but we were able to make that back because the chaos that followed just had huge opportunities because all the capital that provided stability pulled back and says, we don't know what's happening. And during that chaos, there was tremendous opportunity. So we always were able to make it back, but we were able to do that because we preserved our capital. And if I was to yell and scream and jump up and down for everybody on this call, I would like to emphasize what you just said.
Right, absolutely. And that's you know, something that I hadn't even really touched on yet is if I'm risking too much in one position, well, I've almost kind of chopped off one of my legs, because if I already am in over my skis and I have a, you know, discrete event where I get a big pullback in a stock that, I might look at as an opportunity to add to the position, well, where's the money to do that? Where's the dry powder for me to do that if I put all of it in initially, right? Which is why I talk about stop losses here as well. As a beginner, someone who's not so used to trading unusual options activity like this, I still think that using stops is a good idea. A 20% stop is going to mean that you're not having too much risk in any one position because you're probably not used to recognizing opportunities quite as well just yet. Me, I don't use stops and options. And one of the reasons that I don't do that is because I'm afraid of gap risk. I'm afraid that we might come in one morning and a stock that I have a bunch of calls in had an accounting fraud scandal come to light overnight, and it's going to be down 50%. And I have a stop in place that isn't going to matter. So I talk about this all the time, and people that first join our trading room, they kind of get freaked out by the fact that we don't use stops and options. But let me lay out a scenario here for you guys that is actually pretty common that you definitely at one point in your trading career will find yourself in, where I'm long a stock. Let's say I buy 100 calls in stock XYZ at $1. And I put a stop in at 50 cents. That's a good till canceled order. What is my downside risk? Well, my downside risk is 5,000 if my stop just so happens to hold true. But let's say that company XYZ is trading like this, and after the close, an announcement is made that, hey, sorry guys, but we actually have been cooking our books for the past 5 years. Every single earnings report we have given over that time is no longer reliable. And our CEO is resigning and most likely going to jail. What's going to happen that next morning when the market opens again? Because the options market doesn't trade after the bell, right? What's going to happen when the market opens? Well, the stock's going to be somewhere down here, right? And probably continue to fall. Is the 50-cent stop that I put in place going to matter that morning when I come in and look at my position? Is anyone in the world going to give me 50 cents to get out of my position? Absolutely not, right? So rather than buying 100 lot with a stop at 50 cents, I would rather buy half as many and let the entire premium amount be my stop loss, meaning let 0 be my stop. Because what happened in this situation that I just described here is I've lost twice as much money than I, quote unquote, thought I could in the position, right? So rather than, and this is what's great about options, is that long options can never be worth less than 0. So if I buy half as many and don't use a stop, well, not only do I know for a fact that I cannot lose more than $5,000 in the position, I also, if I choose to use this as an opportunity to add, and in this particular example, I probably never would. Let's say there was something else, some other reason why the stock was down this much. Maybe I would choose to add. I have some dry powder left where I can do that. Okay, so, and that's more so important, I think, for small accounts. One of the things we talk about here is reward. And, I always put multiple profit targets out for my position. So if I have a rule that says I can't risk more than 5% of my book, and I know that I want to have at least 3 or 4 targets, that changes and takes away a lot of the trades that I can actually take. Because if I see unusual options activity where options are being bought for $2 and I have a $10,000 account, and I know that I want to take 3 profit targets or 4 profit targets, I know that I can't buy those options for $2. I'd have to buy too many. It would put me in past my skis. So that's kind of something that you guys have to decide for yourself. I'm not going to tell you that this is what the stop loss you should use. It's something that you kind of have to understand where you are in your trading career and where your personal risk tolerances are. But one thing that is really important, and I think this is one of the most important parts of this plan, is after I've identified an order as having the potential to be an actionable idea, I need to have the same time and target as the institutional trader. And this is where I would say 90% of traders who are first using this plan go awry. And it's very natural to want to do this, but it's something that you absolutely cannot do because it's going to put you in a situation eventually that is the worst situation to be in. I think psychologically almost worse than straight out losing money is where you see an order hitting the tape, and because you decided to buy further out of the money options or closer to expiration options that were cheaper, you missed the big move that would have put an extra 20 grand in your pocket, right? It's a terrible, terrible feeling. And it's happened to me before where let's say that I see a massive order of calls being bought on the 100 strike line in October in stock XYZ. Well, I might say, hey, that looks like a massive order, and I think that stock XYZ is going to continue higher, but I don't really want to pay $1 for those. It's kind of a lot of premium. Why don't I look at the 90 strike calls that expire in September, right? And they're going to be cheaper. I'm going to be able to risk less. But we just spent a lot of time talking about why I think that the institutional trader has better information than me, has more analysis abilities than I do, and possibly has insider information that he's not supposed to have. The process of them selecting that expiration and strike was intensive. So for me to come in and try and tweak that just to save a little bit of money is a really kind of foolish idea if I think that the trading plan and if I think that the information is valuable, because it flies in the face of all of the reasons why I'm following the order flow in the first place. It's basically saying, hey, I know they're saying this, and I know that's why I care about this order, but I'm actually not going to do anything that they're suggesting I should here by putting on such a large trade with this expiry and this strike price. So I need to be in the same options that they are, right? That's the line that they chose, and there is good reason for it, right? And if I really do believe that some of this order flow could be insider traders, why wouldn't I want to buy the exact same ones that they are, right? They have the information that I don't have. So take a look at the way that EPD traded here after this order hit the tape. And this is a really good example of a day trade situation. We saw these hit the tape late morning, early afternoon. And the stock continued lower, and these puts explode in value. They traded that day as high as 70 cents, making this trade an absolute blowout winner, right? A 30-cent profit on a 40-cent risk position is massive, and that's in one day. I would have made $600 on $800 worth of risk if I had a stop in if I was willing to let these go to zero in one day. Could close out my position, take the money, and go home. And for those of you out there that day trade stock, I ask you, can you ever really get a return like that day trading stock? And the answer is no. It's very, very difficult. Maybe if you're trading something on the pink sheets that can move around a lot, then maybe you can get that type of return. If that's something that you like to trade, then more power to you. I have never been able to do to play in that game. But this is the type of returns that you can look for because of the inherent leverage that options have. And even if you're someone who doesn't necessarily consider themselves an options trader, you can still use this information for trading equities, right? And we say this all the time. There's a lot of people in our trading room who don't like to trade options, who would rather trade the stocks. And when they see this type of order hitting the tape, will simply short the stock as a day trade. And that would have worked out just fine here. Would have been profitable, would have been a nice trade, a decent winner, but it wouldn't have been anything to write home about like the winner that we see here in the options, right? But it's still something that works out relatively well. People say this all the time. If a market maker sells someone 10,000 calls, sells a trader 10,000 calls, the market maker is now short 10,000 calls. If the stock's a thinly traded stock and they have to hedge themselves, they got to buy a lot of stock into a thinly traded market. And it can create opportunities in the stock as well, right? If I'm someone who's fast enough to get in on that, I can use this stock. I'm never going to get returns like I do in the options, but it's still something that I can apply to that type of plan. So I want to take more questions from you guys. Before I do, though, I do want to talk a little bit about what some of our customers had to say about trading unusual options activity with us. And Charlie says, I want to take this opportunity to thank you for sharing your trading experience. I made $27,000 on craft this morning thanks to the unusual options activity plan that you taught me. Charlie only had on about $800 worth of risk in that position and made that much. Massive, massive profits. Wayne said, I don't want to miss a single classes. All classes are 100% the best educational experience out there. And oops, looks like there's a stray text box here. I don't know why that happened. And Matt said, trading with KOTM has been very, very good to me. We're called Alpha Shark now, but we used to be called KOTM. And he is a trader that made over $1 million in our trading room last year, trading unusual options activity, right? This is a super, super scalable way to trade options. We have people in our trading room that trade with $10,000 in their account, and we have traders in there like Matt who trade with 7-figure accounts. And Matt, I know for a fact, is telling the truth when he told me he made $1 million last year because he sent me his confirms, right? He uses this plan to trade options activity and is able to make that much money doing it, right? fantastic success story. So before I do jump into just open questions and answers here, I do want to give you guys the chance to check out our trading room. So we have a trading room that we run every single day. And what I want to offer you guys today is a chance to try us out for 1 month and trade in our trading room. And it includes all of the entries and exits that we take in a day via SMS, text messages, and in the live trading room. So as we take trades, you see them happen. It includes access to our weekly webinar series, so you can see presentations just like the one I just gave 4 times a week at no extra charge. It also includes daily private group mentoring, where after the market closes every day for a half an hour, we go over hot topics of the day, interesting things that we saw happening, new developments in the market. And what's really great about this private group mentoring is not only is it something that is hosted by myself every day, is that we have a staff of 5 moderators in the trading room, and each one of us has an area of expertise. We have a former Bank of America Merrill Lynch hedge ETF trader in the trading room. We have Andrew, our head trader, who was on the floor of the CBOE for 10 years. We have a new moderator who trades VIX options and VIX futures, who traded for 10 years at various prop shops here around Chicago. We also give you guys, and this is by far the best value part of this package, is access to the best live trading room, in my opinion, in the world, because we have full audio commentary every single day, all day long. And you get to watch all of the unusual options activity coming across the screen and hear our analysis in real time. And we're going to offer this to you guys for $47. It's a 95% discount off of our regular price for all of this stuff. This is by far one of the best packages we have ever put together. The live trading room is something that you can come into every single day. It opens an hour and a half before the market opens and closes in half an hour after the bell. And during that time, there are no breaks. At no point do we not show the scanner that has all of this activity coming across. And at no point is there not someone there who has been trading this plan for years, breaking down the order flow and doing analysis for you guys. And the link here is alphashark.com/mindmuscles. I'm not sure how to share it in the
I just tried to do that in chat window and it didn't seem to come up. Or you did it in the chat, but I don't think they see the chat. So I'm going to.
So here, I'm going to answer one of you guys' questions by text with the link.
Right.
So maybe that'll help. So if you guys go to answered questions here, you can see that you can see the link there. alphashark.com/mindmuscles, $47. It's the best, one of the best packages we have ever put together. If you have any interest in trading unusual options activity or just trading options in general, you guys have to check this out. And one of the best things about the trading room that I didn't even put on this slide has nothing to do with us or our trading plans at AlphaShark. It's the other members in the room. There's over 500 people that pay for the trading room every single month that are in there every day sharing their ideas, talking about what they're trading. It's like being on the trading floor with 500 other sets of eyes looking at things. I mean, they shout out opportunities to me that I miss all the time, right? Like I said, one of the most difficult things to overcome is that I'm just one person, right? I can't have my eyes on every single market at every single moment of the day. But being in the trading room gets me as close to that as I possibly ever could hope to be, right? So I really hope that you guys take advantage of it and come check it out. It's you know, really, really, really unique experience in terms of trading from home. Like if you're a retail trader, it's like being on the trading floor. There's people in there that, you know, and not, our moderators have a lot of experience, but there's a lot of people in there that have experience too, who are always spitting out trading ideas. The community is fantastic. It's the coolest thing about the trading room, in my opinion.
Well, you know, what I really appreciate about this, and I didn't before we started this, was that you have typically price and volume is a generic thing that is an aggregate of a whole bunch of behaviors, but you're taking it and you're saying this is a behavior of a specific type of trader that has a specific goal in mind. And as a result, you can glean a lot more predictive behavior from that than you can from something that is an amalgamation of a lot of traders. So that's one of the things I really appreciate about what you've talked about today.
Right, absolutely. And that's one of the things that is the most important part of what we do on a daily basis, right? Is unusual options activity can be kind of tough to read because you need to know the context of what's happening inside of that volume bar, right? And what our scanner does that we show in the trading room every day is, first of all, it filters out anything that's not unusual volume, right? It's not going to show me 10 lots coming across the tape, right? It's filtered and programmed with proprietary algorithms that show us the quote unquote unusual volume, the stuff that's taking place at bigger than normal volume. But just because stock XYZ is trading 2 times its average daily options volume today, let's say that's 10,000 contracts. Well, is it a significant volume day if those 10,000 contracts are 10,001 lots that are trading, or is it significant if it's 10,000 block? And looking at a volume bar isn't going to give me that context, right? It doesn't tell me who's on the other side of that volume. When I see the large orders, I know it's institutional traders. Retail traders at home, while there are some very big retail traders at home, and I honestly think that I probably know some of the biggest ones in the country, because the P&L that I see from people in our trading room, the swings that they take on a daily basis are absolutely crazy. We had a contest a year ago, and we gave away a free iPad to whoever would send us their confirms at the beginning of the month and the end of the month, showing us how much money they made. And the person that won made $350,000 in 1 month, right? So I mean, they're trading in the size almost near what you would see independent traders on the floor here doing, or things like that. And they use the exact same trading plan as the people who are trading with $10,000 in their account. That's why this is so scalable. That example in ConAgra, that example in Craft, that example in EPD, those were relatively cheap options, right? For 40 cents, I can buy 100 lot and risk $4,000. I can buy a 10 lot, or I can buy 1,000 lot, depending on the size of my account. It's super scalable. And options markets now are more liquid than they have ever been.
They're more liquid. When we were on the floor, the bid-offer spread was sometimes 3 bid at 3 1/4. And if a large order come in, we would bump that to make it even worse. And what you can do, and the commissions, were high. So we have a real advantage to the independent trader now. And I think the biggest advantage is that he can pick and choose. And you've just taught us a great way to pick and choose. And especially in these options, some of them, the pricing is such that you can play with this and learn for so little risk. And I just think this sounds wonderful.
Right, exactly. And we talk about that all the time, because Andrew, our head trader and founder, started his career on the floor as a market maker. And eventually he had to leave. Not because he became any worse of a trader, there just wasn't that much edge down there. The price of being on the floor, the monthly overhead, didn't go down any, but the amount of edge inside of each trade went away, right? As soon as markets stopped trading in nickels, as soon as they could denominate in pennies, as soon as they could list weeklies, it took away a lot of that business from the market makers. It took away a lot of their edge. And, it's sad for those who were making a living on the floor doing that at the time. But for retail traders, that's good news.
It is good news.
Right. And that's the thing, is that, there's opportunities out there in options markets for retail traders that weren't there even just 5 years ago. The liquidity in the market now is so great that, you can trade options as a retail trader just like any other product. And the technology that retail traders have access to do that is so much better than it was even 5 years ago.
The technology you've just shown here is so much better than we had on the floor even when I was a floor trader. And so this is a tremendous opportunity, I think, for independent traders.
Right, absolutely. And there's a lot of people in our trading room. I on a daily basis, I chat back and forth, and the room has live audio all day. And what's great is that it lets you type in a chat text box like any chat room with the other members in the room. And there's ex-bond traders from Bank of America who were on the floor, ex-options traders from Chicago here, ex-NYMEX traders, and they all say the same thing. They all say, if only we had something like this scanner when we were on the floor,
right,
it would have been a world of difference. And I'm sure Richard would agree. If you didn't, and the information on the floor, there was information flow on the floor that you can't get now, right? But that you can't get off the floor. But the technology that's been developed now to track the institutional order flow across all 12 equity options exchanges across the country, instantaneous in real time, is amazing. And you guys, your minds would be blown if you could see the number of orders that come across in a day that are just enormous, fantastic winners. You would not believe it. Today, and I just want to show one example here really quickly. Today there was an order, and we showed this. This came across in the trading room, and we all took this. Every single moderator in the room was involved in this trade. 9,407 XLNX SEP 40 puts were bought for 44 cents. And this was pretty early on in the day at 8:50. So the market had been open for 20 minutes, and we saw this order hit the tape. XLNX, and it's taking me a second here to pull up the chart here. I keep about 12 charts running at any one time during the day, and that sometimes takes me a second to find what I'm talking about. Here we go. So XLNX, really early on this morning, 20 minutes after the bell. Well, I can see that the stock has been in a pretty serious downtrend for at least one session before this. They're coming in and putting on a big, big bet. By the end of the day, almost over 20,000 options traded on that line, which is about 5 times the average daily options volume for all of the options that trade in a day in XLNX. So these traded for 44 cents, okay? After this trader got into this position, what happened? The stock took out the lows. The momentum continued to the downside. And in fairly short order, I was able to take profits in this position. I'm still in some of them. I was able to take profits in that position for 60 cents. Now, that might not seem like a huge amount of money, 16 cents, but relative to the risk that I had on, for me to get 36% profits in just a couple of hours, I mean, you can't really find something like that when trading stock. And a stock trader could have shorted stock at the same time that I bought those puts and still could have had a very nice day. And how did we know to do that? Big institutional selling pressure via these long puts that they're buying. And there's so many other factors that add into making money trading unusual options activity. As Richard can tell you, what happens when you have someone coming in and buying 5 times the average daily options volume in one contract? Well, the implied volatility in that contract starts to run away, right?
Mm-hmm.
And it increases in value. The demand goes up, and it's for astute retail traders out there that are able to find this order flow and follow along with it. There's opportunities like crazy.
Wow. Well, thank you so much. I really appreciate this. This has been a real eye-opener for me. And I hope that a number of you out here who want to be in the equity markets or who are in the equity markets can take a look at the trading room and alphashark.com/mindmuscles. And I also want to remind everybody that we have a boot camp coming up, the Mind Muscles for Traders boot camp. It's starting September 8th, and we have 3 months of really detailed, step at a time work to work through all the mental mind games that you play with yourself, all your frustrations, all your fear of pulling the trigger, the taking profits too soon, taking in too much risk, all those issues. We deal with them one at a time with exercises, simulations, live coaching sessions. So if you want more information, rich@mindmuscles.com. And I'll send you the link. And that's going to be a lot of fun starting in September. We got some great people who've already joined, so just want to give you an alert to that. Okay, anything else that you want to wrap up with, James?
No, I don't think so. If there's any questions that pop in your guys' heads after you leave the presentation, I'm sure there will be. There always is. You can shoot me an email. I'm going to put that.
Put that in the question.
Put that in here as well. I'll put it in the chat also. Shoot me an email, and I will be more than happy to answer any questions that I can.
That's James at alphashark.com.
Yes.
Okay, it's real simple. Just like it's spelled, James at alphashark.com.
Alrighty, guys, and thank you very, very much. Feel free to shoot me any questions. Please take advantage of the offer if you have interest. This is a really cheap price point. Someone did ask, and I do want to address this really quick, Richard.
Okay, go ahead.
Someone did ask me how much this goes to after the trial period is over. So during the 1 month period, you are under no obligations whatsoever to renew. If you do not want to renew, you simply let us know and we make sure that you don't. When you do renew, if you decide to stay with us, and 75% of people that take this trial do end up staying with us and renewing for a full subscription, your price point moves to $199 a month, which is actually 50% off of our regular website price to begin with. So someone was asking about that. I wanted to make sure that that was clear.
Great. Well, I so appreciate you taking the time to talk to the traders who've on my list who are working on their own mental game, and to give them a new indicator and a new peek into the markets. And so I just have been fascinated by this, and I really appreciate the time and the focused attention and the clear explanation that you've done. Good job.
Thank you very much for having me.
Okay, you take care, and everyone out there have a great trading day.